All right, guys, I went ahead and muted everyone. I'll unmute in a minute. If you do have questions, use that chat box in the meanwhile. We had a very profitable trade, and rather than getting the dividend paid out at the end of the year by holding the SPY, Karen K, your trade alert is confusing. Okay, well, we'll take a look at that in a second here. Here's the results of our current trade alert. Now, rather than collect the dividend that was issued, we were able to collect it through selling our put option. And so here's the results of the previous trade alert. We entered into the previous position, which you can always look at yourself by just clicking that link in your trade alert. And you can see here was the trade alert we entered on Wednesday, which was to sell to open the December 20th 318 put, to buy to open the 316 put, and then to buy to open the December 27th 319 call option. You can see this trade cost $1.02, and the SPY was trading at 319.90. So if we come over here, you can see where we entered the trade. Also, I did give us the 2 cents that we picked up in profit between closing out the previous trade at 319.88 and entering the new trade at 319.90. So this is how you audit your returns. You want to keep track of what was the SPY when you entered the trade, what was the value of the SPY when you exited the trade, what happened to the option price, and then you can calculate your net profit. So in this instance, we gained $3.14 per share. And in this portfolio, we're trading 1,900 shares. So that's a $5,966 profit in a single trade. That more than pays for your entire year subscription cost if you're trading that size of a portfolio. To review how to get out of today's position, which is nice to look at side by side, especially if you're getting used to the program. So buy to close the December 20th 318 put. That's what we sold. Sell to close your December 20th 316 put. That was our downside protection. And then sell to close the December 27th 2019 319 call option. So we made a large profit on 3 out of 4 parts of this trade generated a profit. So if we do look, we can see originally we collected about 70 cents selling that 318 put. We were able to buy back the short put for a penny. So we had essentially a 99% profit on that aspect. The underlying asset actually was not part of this calculation, so I do apologize on that. I will send out a fix. So our profit actually was $1.75. My apologies. Because we had actually sold our shares. So our profit was...
Either way, Jason, it still smoked the dividend that was possible. So good job, bud.
Yeah, my apologies, guys. So we had a $3,325 profit. That was an abnormal trade for us because we sold the put, which gave us an interesting risk graph. So I fixed that. Here was our trade risk going into that position. And so you can see that we had downside protection going into the trade where we could actually break even if the position went down $2. And we would only show a loss if it actually had pulled back $4. Meanwhile, on the upside, we were able to generate a profit for every penny it went higher. So again, apologize for the miscalculation there. This is one of the few trades we've done where we sold a put option. So that is our net return on that one. You just have to simply look at the cost to put on the trade and the profit closing it out. So that was $1.75 profit per share on the trade alert from Wednesday through Friday. And again, it did take advantage of a very expensive put option we sold, which was priced into that dividend. Okay, so that's a review of the previous trade. What I'd like to do now is review our new trade alert, which is back to our normal format. And you can see we can generate a profit if it goes slightly down, flat, or up from here. And today's trade alert is to purchase 100 shares of the SPY. So we have to buy back those shares. Then we are selling the 321 call for a credit of approximately 69 cents at the current price. We're purchasing the 320 put for 23 cents. That's our downside protection and ensures that we can collect $320 per share in the worst case scenario. And then we're purchasing the December 27th 322 call option. And so that costs a debit of 73 cents. Now, what's interesting about this trade setup is that we have very limited downside risk. Our maximum risk is achieved right around, it really falls off a cliff after 317.50. So the SPY would have to sell off by approximately $4, and we would only lose $1.13. After that, it really flatlines. So our maximum loss really takes a substantial sell-off of over $10, and we would lose $1.38. So we have tremendous downside protection, but yet we're going to be able to outperform the SPY if it does travel higher. So let's look at that. Right now, we're trading at approximately 321. If we go up $1 to 322, right here at 322.12, you can see we would be at well, let's see, we're really going to outperform the SPY if we go up about $1.50. So if we go to 321, 322.60 right here, we're essentially at the same return as the SPY, but with no downside risk. And after we go above that 322 call we're purchasing, you can see we begin to outperform. So if we were able to travel higher to 323.11, that would be a $2. Let's go to 323.53. So this would be a $1.40 gain on the underlying asset. But you can see at that point, we're making $2.25 primarily from that 322 call option kicking in. So we will slightly underperform the SPY until we get about over 322.50 with this trade alert. But on the downside, if the SPY sells off, we're only losing about 25% of what buy and hold investors are losing. And that really cuts off after we get to 318.50. So we have tremendous downside protection. And let me zoom in on this a little bit more so you guys can see it closer. So if the SPY were to sell off $2 from here, we would only lose 67 cents. If the SPY were to sell off $3 from this point, we would only lose 89 cents. And if the SPY were to sell off $4, we would only lose $1.21. So you can see we have tremendous downside protection. Now on the other side of the trade, we're slightly underperforming for the first dollar or so. So in this setup, if we went to $1 higher, we're up $1.34. So we're actually outperforming already because of that time premium. Now, if you held this to expiration, you'd be just about even with it. But our intentions are to exit this full position on Monday. And so realistically, I think the maximum return we might see between now and Monday could potentially be a move to 323. So if that were the case, we'd be looking at about $2. If the SPY were to travel $2 higher, we'd be just at the same return with much less downside risk. So that's our setup for today. Let me go ahead and jump into the trade alert.
Hey, Jason.
Yeah, go ahead.
Is the reason why you closed out of the December 27 call, the 319 call this morning was just to lock in profits and then reposition? Or
Correct.
Okay, because I was kind of surprised you just didn't let it ride if you were feeling as it's going to continue. But then I thought, okay, I know Jason's thinking, let me rethink this. That's probably what he's doing, is to lock them in and
yeah, so we're going to close out and re-enter the SPY position every trading period. And so not only does that make it easier for new members joining in, it also makes it easier for you to keep track of what's going on.
Okay.
So yeah, and we did replace that with a little bit more bullish of a call option. So there's a little more leverage in that 322 versus the 319.
Okay, thanks.
And so we're doing something very similar, but in the opposite direction on the TLT. So let's go look at that real quick. Now also, guys, it's just too much work to calculate the P&L of every single asset in our portfolio every morning. So I'm going to do that every Friday after the market closes and send you a track record video, really going through it with a fine comb, each strategy, how it's performed, with a breakdown on the monthly return. So expect that to come out every weekend. Let's look at our open positions. So our emerging markets position is finally in the green. We're up 15 cents. We had to get past that barrier, which was the put option we purchased to provide downside protection through January 10th. And so the math on this is we went from 44.21 to 44.59 as of this morning. I think it might be up a little more. This was the initial cost of our put option, 61 cents. And the current value was 38 cents, bringing our net profit to 15 cents a share. And again, this trade, we're just long emerging markets, and we have a put option for downside protection. The trade alert given out on the TLT is slightly up. So the math on this is we entered the trade at 136.45. And as of shooting the, updating this document, we were trading at 136.26. So we sold the 134 call, that was the in the money call, expiring December 27th. And then we purchased the long 137 January 3rd put. So once again, the portion of the trade we're really trying to generate the profit from has a little extra duration with that January 3rd. So we will still close this entire position out on Thursday and then roll it into the next week, even if our put option is up. So very similar to what your question was related to that, that call option we're taking a profit on this morning. The initial caller gave us a credit of $1.33, and currently we could buy that back for $1.07. So we're making 7 cents a share betting down on the TLT. And so the basic idea is to collect a large credit from selling an in the money call and then turning around and purchasing an in the money put. And that's our inverted option caller. And that's how we're generating a profit on the downside on TLT. GDX is entering its hot season coming up. So we're simply long GDX with the same January 10th put. So we do have to work off the initial investment to protect the downside position on that put. So currently from the previous trading period through today, we're still flat and our put option has lost a little bit of value, 16 cents precisely. So we're down 608 on this position. And I suspect that we can see a nice rally on the GDX coming up. To review how to get in and out of the previous trade, buy to close your short put, which we generated a substantial profit on. Sell to close your 316 put. If you can sell it, now it's valued at a penny, so you may not be able to get out of that position. If so, you can allow that to expire worthless. And this portion of the trade, we did not generate a profit on, but meanwhile, our call option did go up significantly. And so we can see it went from $1.46 to $2.77. So that's how we exit the previous trade. To get into the new trade, step one is to own 100 shares of the SPY. And to achieve that, second step, we would sell the December 23rd, that's expiring Monday, 321 call, and to buy to open the 320 put. So that's our downside protection, which is selling very cheap at 21 cents. And then we're buying to open the December 27th, 322 call. So that's a much more leveraged position. We're taking profits out of that previous near the money call option, and we're leveraging up with a cheaper option that's further out of the money with the 322 call. So that's a review of this current trade alert. Now let's see if we have any questions out there on the current trade alert.
Jason, this is Jeff.
I can hear you. Go ahead.
Just real quick, just a question, just going back. I would just, if you guys could go back and do a deep dive analysis on the dividend payout and how that works. I think the SPY right now without the dividends trading at about $1.2270 or something like that. But if you guys could go back and take a look at how that dividend actually does work, because I know it complicated the option premium. That's all I have.
Sure. So yeah, at the close yesterday, they discounted the SPY by the dividend price. And so, yeah, certainly. Rather than taking the dividend, we were able to collect a pretty juicy put option. So that allows us to essentially have a little bit less risk versus simply being long that position. So yeah, you're the one who pointed that out last Wednesday, right?
Yeah.
Yeah. So you were correct in terms of the pricing on that put. So essentially, you can either be long the SPY and collect the dividend, which is getting paid out on December 31st, or you can sell the put option, which has that built into the price. So we actually took the option to sell the put, and that's why we had such a attractive P&L graph where we can generate profits if it goes down, flat, or up, and that is because of that put option. So that was a very good point you made last Wednesday.
Hey, this is Gary here, first time viewer, Gary Densky. You guys are always long when you're selling your covered calls. You're always long the underlying, correct? And you're selling cash secured puts. Is that how you pretty much operate?
Well, we sold the put on Wednesday because of the higher premium, which was due to the dividend. Most of the time, we're going to own the underlying asset. Now, we're not always going to be net long. So let me show you an example of how we were able to own the underlying asset on our TLT yesterday and bet down. So here's yesterday's trade alert, which was up this morning. So here was the TLT trade alert on Thursday, which was yesterday. So in this setup, you would own the underlying asset. And now you can see we sold the in the money call option for $2.63 credit. And then we purchased a longer duration 137 in the money put option. And so this allows us to essentially finance the entire trade by owning the TLT and position ourselves to benefit from a downside move. So this is how we can do what I call the inverted option collar. Now, compared to today's trade alert, you can see we did the opposite of that. Where we own the underlying asset, we sold a at the money call option and a near the money put, and then we're long a slightly out of the money call option. And that's just because I'm become very bullish now that the China trade war is in a phase of de-escalating. Does that make sense?
Excellent. Yes, very good. Just a follow-up question. Who do you like to use for your platforms for trading?
I really like the Thinkorswim phone app, really the best.
Yeah, that's excellent.
Because it's very easy to use. It does trade Forex and stocks and options. So if you ever get into our boot camp program, we do have some currency plays. So that's really my recommended broker dealer. Now, as far as this graph, this is some old school software I've had for a long time. That's just super simple to illustrate, but I don't do any trading. This is Dynamic Trend if you ever want to check out their platform. But you get similar, I have this same risk graph right from the Thinkorswim phone app, right when I place trades. So if you do really want to get into it, Thinkorswim's desktop platform is really the best out there in terms of feature set. What do you use currently?
I have enough in Thinkorswim that I certainly could do this, but I do have a pretty significant portion in Fidelity, and I've done a limited amount of options trading with Fidelity, not a ton. I just wonder how good their platform is.
Well, if you use either Schwab or Ameritrade, you're going to certainly save a lot on commission costs. And their phone app, the Thinkorswim phone app, is beautiful. I mean, I can put this on with, open it up, type in SPY, hit the option chain, click the two options, look at your risk graph, hit submit, you're done. It takes, maybe 60 seconds. So I would really recommend that. A lot of our clients are taking these trades on the go from the text message. So that's definitely what I'd recommend.
Have you ever had experience with Fidelity's site?
I've never traded Fidelity myself, so I don't have any personal experience there.
I do.
You like Fidelity, Karen?
Well, it's where my, retirement stuff is. All I can tell you when I looked at the differences more than anything, because everybody's got zero commissions. Biggest challenge more than anything is trying to get them to reduce their, per contract rates, which I think just takes a little time, and then threatening to leave them.
It's just like when you threaten to leave Comcast, all of a sudden the cost goes in half.
Yeah. But I will say this, Fidelity does have very good fills.
Okay.
So, which is not so much of an issue with a lot of what Jason is doing, but you're just going to have to kind of play with that a little and figure it out. So, but their phone app is terrible. So it just depends on,
Yeah, their phone app is terrible.
That app is terrible. You have to sign in and do it the long way, but you have to just decide what you're doing. So
good. Thank you very much.
You're welcome.
Yeah, no worries. Okay, guys, I'm gonna go ahead and hop into the top news unless we have any other questions on today's trade alert.
Definitely, please feel free to jump in if you do have a question. Obviously it's going to be the most important to touch on the trade alert question. So please, if you have any questions as to why we're engineering, please jump in and ask.
Yeah, in general, right now, I'm trying to design trades that allow us to at least keep up with the market, if not outperform it when we can, but at the same time have dramatically less risk to the downside than just simply buying and holding. So that's exactly what this trade alert does. You can see just visually for upside potential, it's unlimited and it slightly outperforms the SPY, especially as if what this chart's not very good at calculating is the time premium value, which is inherently in that December 27th, 322 call. This is more of a calculation if you were to buy and hold to the exact expiration. So I would say this is slightly miscalculating to the in terms of undershooting what our potential return is come Monday, because we're still going to have a lot of time premium on that 322 call. But on the downside risk, it is very accurate, and it just would miscalculate implied volatility, which may make our short call repurchase a little less than the normal. But you can see we have a very limited downside risk and unlimited upside potential. So it's definitely a much smarter way to play the upside in equities, realizing that we're really playing quantitative easing and a de-escalation, which is going to cause a ripple effect in the bond markets, which I believe will be flowing into equities, even though prices are already nosebleeding high. Let's see, Michael, I do notice you have your hand up. Do you have a question still? It might have been up for the whole period, so.
Yeah, I think it was up earlier, Jason. But Michael's actually calling in from Israel, from Tel Aviv. So,
Okay, great.
especially our first person that's called in from Israel.
Nice. Okay, guys. Well, let me go ahead and continue on. Let's look at some news. Let me pull some charts. Just tell you what exactly I think is coming our way and why. Okay, so.
Gonna go ahead and mute everyone too, Jason.
What's that?
You want to go ahead and mute everyone just real quick? There's a little bit of feedback.
Sure.
Thanks, bud.
Okay, so for the past 4 months, we've been trading, and I'll pull up my slide. We have essentially 3 go-to trading plans based on what's happening in the trade war, what's happening with interest rates, and what's happening with the Fed's balance sheet. And my concern, and this is actually going all the way back through July, was I felt that if Trump wanted to create chaos with China, he'd have to do it well before his election and then patch things up before we went into to near the election period. And that's because there's never been a president reelected during a recession, and it was almost certain that if China's growth continued to crash at the speed it has been for the past, really since 2010, more so in 2015, and especially in the last 2 years since the trade war began, it was quite clear that China single-handedly could pull the world into quite a recession. And the short-term reaction we'd seen were emerging markets struggling, European stock markets struggling, stock or bond products, especially sovereign bonds around the globe, going into negative interest rates. Germany's 30-year yield went to a negative rate for a little while. So the bottom line was all the pressure on China, which has been the growth engine of the world, I'll pull up emerging markets, was slowing down at a rapid pace. And with all the pressure from the US, it was accelerating this GDP crash in China. So I was very concerned that even though we were watching all this money flood into US products because it was such terrible conditions in emerging markets and especially in China, that we had a potential breakdown in equities and a further push up in bonds if the trade war would have continued to escalate. And so we've really just had quite a magnificent cat fight over the past few years. And so if we do look at the TLT, this is where we've been slow bleeding in our portfolio. We've been losing around 1 to 2% per month for the last several months with a long position in the TLT. Now, we've done very well for all of the past 7 out of the past 12 months being long the TLT. As you can see, it was a huge move up. And essentially, you had a setup where you could lose 1%, but stood to gain anywhere from 5 to 10%. So I was willing to be long equities with the caveat that we were also long the TLT. And the strategy was, if the trade war would have escalated, the likely outcome is a sharp sell-off in stocks, which is okay because we're constantly protecting against the downside with our put options. And then to have a open long position on the TLT, which you can see tends to have these huge shoot ups to the upside. Okay, but now the trade war really does seem to be in a de-escalation period. Some of the news today is that Premier Liu is going to fly to Washington to sign the phase 1 trade deal. And so the world is now taking a deep relief, a lot of sigh, and everyone who's rushed into bonds that are yielding less than the inflation rate are scratching their heads and starting to figure out that these yields are going to climb until we have another crisis. So my expectation, as long as China plays nice, which at this point I do think they will, but we'll see. That's one of the biggest things I'm watching as far as a wild card for the markets. But if they do play nice, my expectation is to see yields climb until it crashes stock markets. So the best example of this is actually going back to October of 2018. Now, those yield hikes were driven by the Fed actually physically moving interest rates higher. So this time around is a little different, but the amount of debt has grown substantially, and the bond market's becoming more and more sensitive to interest rate changes. So right now, the Fed says they're stuck on hold unless something deteriorates, which is very negative for the bond market because they are counting on more rate cuts to drive this higher, which I do think are coming eventually. But I think first we're going to see a sharp sell-off in the TLT. Now, I'd be surprised if we go below that 115 level, which we saw in 2018. And you can see hitting 112 on the TLT just tanked the stock market. And I'll talk about why in a moment. We'll go look at the yield prices on the 10-year treasury at that period. Now, TLT is playing your 20, 30-year treasuries. The market has become more sensitive now than it was then. Stocks are much higher. Everything's more leveraged up. So it's going to become more and more sensitive to bond yields getting too attractive. So my expectation is we can see the TLT crash quite rapidly to around 120. So somewhere between 120 and 115, I think that will tap out the stock market and force the Fed to go from not QE, which we'll talk about what is not QE compared to real QE. And so I believe that we're going to get a stock crash as TLT hits 120. And that's going to force the Fed to go back into a series of rate cuts as well as real quantitative easing. So what is quantitative easing versus not QE? That's what Jerome Powell's talking about, and it's extremely important for understanding how to play the TLT and the stock market for that matter. So let's pull up our yield curve. So the first time, well, let's go back to the last stock market crash. We can see what happened. You can see that 10-year treasury just budged over 3%. That is just irresistible to the banks. So if you believe interest is at 2%, or rather inflation, and you can get a guaranteed 10-year return of 1%, banks are going to leverage up every penny they can into that trade. And it's for two reasons. Number one, the yield's extremely attractive. So they will go max out as many dollars as they can possibly muster up, realizing they have essentially a guaranteed real return of 1% a year, even if the yield stays that high. But if the Fed lowers interest rates, which is exactly what they did after this stock market crash last year, then you can realize a massive return by holding your bond. So essentially, you're going to get a couple of things. Number one, all the banks know if yields get too high, it's negative for stocks. So they're going to exit those huge profits on the stocks. Two, they're going to get a guaranteed return for 10 years, anytime that goes well above the inflation level. And then three, they know the Fed is not going to allow the stock market to crash for too long, which would continue to cause havoc for employment, for price stability, everything they're trying to control. So the Fed has a pretty straightforward reaction anytime stocks crash and yields get too hot, and that's to lower interest rates. And so sure enough, they went into a massive period of cutting rates this year, which drove this yield way lower. You can see it's dropped from 305 to $1.92, and essentially got us this massive stock market rally this year. So my expectation is, as long as the stock market is rallying, we're going to see these yields start to climb back up. So let's go back to our TLT. So you can see the banks did quite well with this whole buying the expensive bonds, or rather the high yielding bonds. And the TLT during this period of lowering rates, that's the key, went from 112 to 147. So they picked up around a 30%, about a 25% gain on the TLT, or on the long end of the treasuries that they purchased. So I think we're going to see a repeat of that. Timing will be tough, but the faster the stock market goes up, the more debt the US prints, that's going to expedite how quickly this happens. And so the whole world's waking up that they jumped into bonds at these low yields, expecting that they would go even higher, primarily because of China slowing down. And now that catalyst is off the table. So unless we see the US-China relationship aggravate once again, there's really no pressure to tip these yields lower and lower. In fact, we got the US growing its debt versus GDP, now at 7%. So it's the worst growth to debt ratio in the world of any major economy right now. And there's no sign of a slowdown in fiscal spending really anywhere worldwide. So I do suspect this could be quite a vicious drop in the TLT and an explosive move to the upside on the SPY. And so let's talk about why they call it not QE versus real QE. So I'm going to delete the September. So this is what happened to yields right before stocks crashed. Now let me just do this real quick. Let's look at how the yield curve performed all year during this big bull market in 2018. And so you can see exactly what I'm talking about, how these yields just climbed higher and higher and higher until it cracked the stock market. So let's look at what's happened in the last few months in the bonds and what the Fed's doing, which they call not QE. So here we are today. I'm just going to go back in time so we can see what's been happening. Okay, so I'll start to peel off some of these, but we've gone back to April of 2019, and that's when the yield curve started to invert. So what the heck is yield curve inversion? I know we've all heard of it. Essentially, that's when you get paid more to buy short-term debt than you do long-term debt. And that really doesn't make a lot of sense, and it doesn't calibrate correctly with how banks go about borrowing from the Fed and then turning around and lending it to consumers to generate profits. It's also been a leading indicator about 18 months out of a recession like clockwork. So let's take a look at what's happened. So the yield curve inverted, and it was especially bad in May. In fact, you can see the 2.3% yield on a 1-month treasury, or rather a T-bill. And then your notes are only paying 1.9 if you lend the government money for 3 or 5 years. So let's delete that. This only lasted a few months before the Fed eventually had an emergency meeting in September. And so you can see in August, it was severely inverted, just egregiously inverted. And so what did they do? Well, they came in with not QE, and they call it not QE because they're only buying the T-bills. That's your 1 month, 3 month, and 1 year treasuries. And because it's short-term debt that'll wash away in a year, they're saying this is not quantitative easing, even though it does have the same effect of increasing the money supply and increasing the balance sheets on banks to be freed up into cash. And now they're doing it with repo, which they also call not quantitative easing. And so let's see what happened as they went into not QE. Well, you can see they dragged these yields way down, which steepened the rest of the curve. And so that leaves us at where we're currently, where we can see it's almost as if it's a kite. You can see the long end is trying to fly away here. It's not following the front end whatsoever. And so this is the distortion in the markets that the Fed is implementing currently by putting $60 billion a month into these 3 T-bills, so the short end of the curve. So what everybody's expecting will happen is, again, the middle of the curve and the long end of the curve will continue to rise without support from the Fed. Eventually, those yields get so expensive, or rather so attractive, that money will jump ship from stocks into the guaranteed return. Now, right now, if you really believe the Fed's going to create 2% inflation, which they say is their target, in fact, they're talking about running it hot to make up for all of the missed inflation we've had. So if you thought there's potential for 2 to perhaps 2.5% inflation, well, you're not going to be too attracted to earning 1.8% for 7 years or earning 1.92 for 10 years. So as this gets, the latest calculation that's been put out is that around 2.8, the 10-year would become too attractive and cause a stock crash. So my expectation is just that stock market's going to go berserk because we have massive quantitative easing in 3 out of 4 banks. We have Europe, Japan, and the US printing. China is not yet. They're only purchasing the front end of the treasury curve in the US. And so this is going to find its own natural interest rate, and it's going to have to compete with stocks going sky high and a whole lot of people selling bonds who realize that they purchased these bonds in the last several months, hoping that a trade war would escalate and that yields would go significantly lower so that they could sell those bonds for a profit. But now everyone's waking up and realizing exactly the opposite's happening. We're having a de-escalation in the trade war. This time it does seem like it's the real deal. And so there's a lot of people selling these bonds and now flipping into equities. In fact, 2 of the biggest bond experts have completely flipped on this trade. Well, Jeffrey Gundlach, for one, has actually been bearish on the bond market for quite some time. But Stanley Druckenmiller, who was last year during his Bloomberg interview pitching to buy the TLT, which did very well, actually specifically that 10-year, which did extremely well. He's in the exact opposite camp this year. So even the biggest legendary bond bear investors have gone bullish from this change. So that's what I'm looking at. Let's go back to our chart. We can just kind of simplify this. So TLT has tremendous pressure to the downside until two things happen. Number one, we need the Fed to signal that they're going to cut interest rates, which they said they will not do unless things materially change to the downside. So that's, if you read between the lines, that's either trade war escalates or stock market crash. So we don't have that in the books at all right now. So there's really very little chance of the Fed cutting rates. As the stock market goes to all-time highs, unemployment is at a low rate, and there's no pressure with China. Plus, we have a positive outcome in Brexit for England. So that's the big picture on the TLT. So most likely this crashes to somewhere around 120, and that's when your yields are going to get so attractive that we do cause a stock crash. That's when I suspect the Fed will cut interest rates and do real QE. So real QE would be purchasing the middle or the long end of the Treasury. And that's what will really drive these yields back down and restore the stock market. Now, as far as what would happen if we did cut rates to zero and actually did quantitative easing on the middle or long end of the Treasury curve, that's where we finally get to that, what I believe will be the record high in the TLT in the coming years. And I'll do more calculation as we get closer to this, but we can look at how low the German 30-year yield went, which was about negative 30 basis points. So if we kept perhaps about 1.5 to 2 above that, the potential run up on the TLT is substantially higher. Now there is a top to how high the TLT can go, whereas there's not a top to how far the S&P 500 could go over time. The TLT is really constrained by the Fed pushing rates to zero. Now, unless you think they would be willing to go into negative interest rates, probably the record high we could possibly see is going to be somewhere between 160 and 180. And that again would be from two big powerful moves by the Fed, cutting interest rates to zero. Currently we're at 1.75, and then not just buying the front end of the Treasury curve, but buying the middle and long end. So how long could these moves last? My expectation is probably this crash on the TLT could lead all the way up to the election. So we may see quite a market rally all the way up to and into the election. And then perhaps that's when the risk off move happens. So we might see this TLT crash all the way into 2020 and then a big spike into 2021. As far as how fast the Fed will cut its interest rates and do the quantitative easing, this could all be happening at the same time we re-enter the drama with China and try to get more concessions out of them. So I think Trump will be happy to just kind of let things slide through 2020 as long as they're making a half decent attempt to purchase agricultural products, and that he's going to be very shy to aggravate the U.S.-China relationship heading into the election. So that's what I'm thinking in terms of timing. It could happen faster than we expect. So we'll have to keep a close eye on that. As far as the SPY, I think we'll see a little volatility, but really there's not a whole lot to be concerned about when you have 3 out of 4 biggest banks in the world printing at rapid pace. We have a de-escalation in the trade war. So except for the 10-year Treasury becoming around 2.8% yield being a concern, the next biggest concern I have is this specific ETF, which we can watch. This is your investment grade bond fund. And so this is a Jeffrey Gundlach has really made this popular. And if you're in the boot camp, I'll be sending you 2 really good interviews. One you got this morning with Stanley Druckenmiller. Definitely watch that. Second one is I'm gonna give you my password to get access to his webcast, which is always good. He does one a year where he gives out his predictions. For the most part, he is dead on. This year, perhaps him and Ray Dalio were a bit early on some predictions, which were primarily that we'd have a weak dollar, strong emerging markets, and rising rates. But I think he was just a little bit early. So we'll see how those play out. But here's the chart to watch for. Let's see if I can zoom this out. This is what will really break the stock market. And rising interest rates are going to certainly apply pressure to this ETF. So this ETF just represents a basket of investment grade corporate bonds. Now, inside that basket, you have some great companies like Microsoft and Apple who are actually able to go overseas and borrow money at a negative rate. So if Microsoft can get paid to borrow money and buy back their own stock, do you think they'll do it? Yes, of course. But if we start to see this start to pull back, that's going to show signs that investors are less willing to bet on bonds going lower and lower. So I do think that's going to be the trend for 2020, is that everybody who's bought bonds that have too low of a yield are going to start wondering why they purchased those as they see the value of the bond head into negative territory. So this rising rates is going to be negative for all bonds in all markets. So this is not a bad ETF if you look at your Apple and your Microsoft, but there's some companies like GE and AT&T who have just horrible balance sheets, massive loads of debt, and probably should be re-rated into this ETF, which may crack first. This is your high yield debt. And so the big prediction is that there's a big block of BBB rated bonds in the LQD tranche that should probably be moved over to the high yield corporate. And the problem is these bad companies, these bad apples, are getting rates at a much better credit rating than they really should be. So if they were moved and re-rated, those yields are completely out of whack. And we can see the high yield ETFs nowhere near as strong as the investment grade. So that's really the biggest thing to look out for in terms of a long-term bear market. Now we know the Fed still has really one last blast of ammunition to prop markets and prop the credit market. And that will be pushing those rates to zero and not just doing quantitative easing on the front end of the treasury curve, but to move into the middle and long end. So these are probably the two most important ETFs to watch to have a good look at trouble ahead. Now, surprisingly, we've got the junk bonds are rallying currently, and your investment grade ETF sits at an all-time high. So the ability for corporations to borrow and buy back their own stocks is at a record easiest period in history. So despite the SPY being at nose-bleeding prices, you don't have to, all your typical analysis of whether it's going to be a good PE ratio or anything of that nature is completely out the window. We have the Fed, Bank of Japan, and the ECB printing massive amounts of money, taking pressure off the banks, who are in turn buying up corporate debt, which is these products, LQD. And what are the corporations doing with the money? They're buying back their own stocks, which is creating this massive bubble. So it's self-fulfilling. And really the key to watch here is probably that 10-year treasury getting back to a level like it was last year when we got that Christmas sell-off. So that's the main things I'm looking at. Now, if we are doing a lot of money printing, that's very bullish for gold. This one's GDX. So if we do look at the last time we did quantitative easing, it was in 2009. And you can see how gold reacted to that. All the fireworks for the quantitative easing are about to begin. They're just getting started. And so I do suspect that we can actually go well beyond where we were at in 2010 because we're trying to paper over a much larger loss, primarily from China's bad investments in real estate and construction going into the year. Plus, we have massive amounts of corporate debt, massive amounts of debt in the US. So this is all pushing towards policies that will be very fiscally stimulative, increase the balance sheets. And if we are increasing the amount of capital in the world and there's still a finite amount of gold, that'll make the relative value of gold go up. So I do love being long GDX, but again, this will be a patient one. And you can see gold seems to just kind of leap up. So in this portfolio, we're simply buying a put to protect against volatility to the downside. And then we're expecting big leaps in the price, which we will then lock in by purchasing another put. So we're set to jet on this trade until July 10th. And we'll probably do a similar trade on July 10th to buy a one-time investment in a put to protect us against downside risk. And then essentially speculate that gold in terms of GDX will rally at a faster rate than the cost of our put option. Now, emerging markets is the last piece of our portfolio. There's a whole lot of reasons to be shy with emerging markets. But again, we have 3 central banks doing quantitative easing. We have to be long equities in that environment. And the one thing that would really scare emerging markets would be if the US were to cut off this proxy to China, which is really a US product. This is something that's traded through US institutions, not through Chinese institutions. So the biggest risk to emerging markets was really being cut off of US capital because of a major PowerPoint that the US had in the trade war. So that seems to be off the table. We have an election. Trump wants to win. So I am expecting a pretty clear coast up until about November of 2020. So quite likely we'll ride this all the way to the election and then sell the election and flip our position. So we'll go from being long stocks and short bonds to being long bonds and short stocks somewhere around November 2020 is what I'm really expecting. Now, again, what might make me think we should flip sooner would be something like what we saw creep up in 2018. And you can see how that worked. Those rates just climbed so quickly until it did crash the market. And you can see that in the course of a year, by September, we were able to climb rates that were a little bit less of a move than we've had this year. So for us to get to similar levels, we're starting from a lower point. So we'll see if it will happen as rapidly as it did in 2018. So from January through September is when we saw that big move last year. We'll see how quickly this happens this year. Now, the bigger issue is that overseas, there's a lot of negative yielding debt, and those are going to be tremendously underwater. So I do suspect we could see a lot of people exiting bond positions worldwide at a very rapid pace. Now, are they going to flip into local equities with those bonds that they purchased? Or are they going to start picking up attractive US treasuries, which would be a little bit of a headwind to slow down the current yield curve hitting those dangerous levels, which I believe will be somewhere around 2.8 to 3 on the 10-year treasury. I think it'll really be a warning sign. And, you know, not only is that just attractive if you think about it against inflation, everybody who knows anything about the markets knows exactly this fact that last year in September, once we got to those levels, stocks tanked rapidly. Okay, so let's take a look at the news. Well, first of all, let's see if we have any questions out there. Go ahead and unmute everyone for a second. Any questions out there so far? Okay, great. Well, let me go ahead and jump into some of the news. And then we'll give this back to Dean to close out. Okay, so I've just pulled up my Twitter feed so we can hit the highlights and not miss out on any fresh news. So we'll scroll through it. But some highlights, we have Ray Dalio, Jeffrey Gundlach, kind of the same prediction that they've been having since last year, which is a weak dollar and essentially rising interest rates on the treasuries. And I think that will play out at least for the next 10 months. We've got Stanley Druckenmiller came out on Bloomberg. He does this once a year. Last year, he's essentially, he was long treasuries. That was his big bet, and that paid off very well. We do have a question. No, we're protected through January 10th on GDX. So we'll probably be buying a 1-month put. And essentially the bet on that is that the GDX can appreciate at a greater pace than what we're paying for our downside protection. So it allows us to continue having this low volatile strategy and generate profits on that play. Late to join. Yeah, review the trade. Sure. So I did have a miscalculation in the email sent out. I fixed it live. My apologies on that. Basic trade was very simple. We paid $1.02 to enter the trade, and we sold it for $2.77. So yeah, let me pull up the trade. Now, normally we're having to track the change in price of the underlying and then the change in price of the options. But in this rare case, there was a dividend over that period. So rather than hold the asset and get the dividend at the end of the month, we essentially got the value of that dividend by selling a put. Now, we could have made more if I'd sold a more valuable put, but I wanted to have a risk-free trade. Let's take a look at it. So here was your trade setup from Wednesday through today. And what's important is not just how much money we made, it's to understand what your risk was to achieve that return. So had the SPY sold off $2, we would have still had a profit, and that was because of that dividend. If the SPY traveled higher, we generated a profit that outperformed the underlying. And if we had sold off, we had very limited risk. So you can see in this example, when it was trading at approximately 320, had we sold off to 317, you would have lost $300 or $3 a share. With our trade setup, you would have only lost $1 or $100 per contract. So we're not just going long and hoping we get lucky and not worrying about downside risk. With our trade setup, we'll actually lose less than buy and hold investors, but still keep up with their returns to the upside. So to review, let's just look at the trade. So this was the previous trade. This was the entire trade. So we didn't actually own the underlying asset in this specific trade. We had sold the 318 put for a credit of 73 cents. We purchased the 316 put. So that was our absolute maximum loss on this. Was essentially the difference in the credit from the 318 put we sold versus the 320, or rather the 26 cents we paid for the 316 put. Then we purchased the 319 call. So the net cost on this trade was $1.02. Now, if we go to today's trade alert, you can see we were able to close out the position. On the put, which we sold, we had to buy it back. So we paid a penny to buy it back, essentially a 99% profit on that piece of the trade. The put option we were long, we only got a penny back. So that's what we were hoping for. That was our insurance. So we did lose 99% of the 26 cents. So you can just start tallying this up. You made 70 cents approximately on the first part of the trade. You lost 26 cents on your insurance. That's what protected us against downside risk. And then the call option, we paid $1.47 and we were able to walk away with $2.77. So if you simply subtract the credit versus the cost, you're sitting on $1.75 profit per share, $175 profit per contract. Does that make sense? Now, the way you'll calculate this week's trade, this weekend's trade at least, we're going to keep track of where's the SPY when we entered the trade, 321.27. We're going to keep track of what we paid. So we paid 22 cents. So come Monday, we want to keep track of two things. One, what's the new price of the SPY when we exit the position? And then two, did we get a credit or a debit back from the options? And so we'll simply take the net return, and that's your profit per share. Does that make sense on how to calculate the P&L?
How do you get to the 277 cents profit?
Yeah, sure. So here was the first trade. This was a trade on Wednesday. So we paid $1.02. You see the debit? So we sold 318 put. That's a credit. We bought the 316 put. That's a debit. And we bought the 319 call. So that's a debit. So overall, that entire trade setup cost $1.02 or $102 per contract. Now to exit today, we buy to close the put, we sell to close this put, and we sell to close the call. And you can see the credit, the net credit was $2.77. So this trade was a little easier. You look at the cost to enter the trade, cost to exit the trade. Does that make sense?
So is it 316 plus 319 minus the 318?
So
No.
like you want to
No,
break
no,
it
no, no.
down individually?
No, that's not right. The price, that's the strike price.
Right. So the price is over here. So the first part of the trade paid us 73 cents because we sold the put. So we go back to the other part of the trade. We had to buy it back to close out that short position for a penny. So we kept about 69 cents on the short put. Okay. Now the next trade was the long put. So we paid 26 cents. And what did we get? When we sold it back, we got a penny back. So we lost 25 cents on our insurance, the downside protection. The last part of the trade was we purchased the 319 call for $1.47. And we were able to sell that today for $2.77.
Oh,
So the overall trade cost $1.02 to put on. And we were able to get $2.77 back.
oh, okay.
So we made about 50 cents on the put portion of the trade, and on the call option, we made $1.20. So about $1.75 total profit. Does that make sense to everyone?
I cannot see the price of the contract.
Oh, okay. Here's the screenshot of exiting. Here, I'll copy this so they're back to back. I'm just pasting this here so you can see them next to So the top is the trade we entered,
Nice, Jason. Yeah, that's a great example. Good job.
and then below's the exit.
Mm-hmm.
Now this is a trade anybody could have done without having to lay out the 30 grand, because we had the downside protection on that put. But normally we do own the asset and then sell a covered call. So we're usually doing a little bit different trade. Does that make sense?
Yeah, sure. Thank you.
Sure. Yeah, no problem.
Hey, everything looks excellent. Do you guys have this somewhere where we can see your long-term track record?
Yeah, sure. Let me pull that up. This weekend, I'll be doing a detailed video. Every weekend, you can expect a detailed update. I was doing this every day, but it was just too hard to pull this all off in a couple hours in the morning. But I would say we have the best accounting by far of anyone in the advisory business. And it's very detailed. So let me just walk you through it. You do have access to this typically in your updates. In fact, I'll post it in the chat so you can grab that now. So here's how, and actually, if you do join, you get a copy of the spreadsheet. Many people who join are not able to just watch the tutorial and do this. They really need hand-holding. Our boot camp does dedicate an entire 6 weeks to just filling out the trades together. So we'll be entering all our trades as a group. So Scotty's in that. Quite a few, I'd say quite a few of our customers are actually in the boot camp and the advisory. So most of you guys have been watching me with the fancy looking track record, but in the boot camp, we're going to fill it out together, and you'll have the same accounting that I have. So essentially on the summary tab, we have your total return since conception, which was middle of December. So we jumped into this right in that nasty Christmas crash. And what I'd like to point out, in fact, I'll just show you this.
Hey, and Jason, while you're on that too, guys, we do have 2 spots left for a 50% discount to get both the advisory and the boot camp today. So if you want to lock that in, just give me a call, 505-322-7515.
Great. So what I'm going to do right here is just show you against the S&P 500 how well we've performed. Now, the basic idea is that your bond position will protect your stock position. So most of the time, I actually want to be long stocks and bonds at the same time. And the result is that if the S&P 500 crashes, because I have that tight put option, it cuts off the losses very quickly. And typically, the bonds will rally as money's jumping out of stocks from whatever's scaring it into bonds. And so you can see in December, who would have known where the bottom is, or that suddenly we'd rebound? As far as I knew, it kept crashing. But because of this strategy of being long stocks and bonds, we can do well even if the market's going up or down. So you can see in December, we had a 1% return. Now, are we outperforming the SPY in January, February? No, because I was still very worried. It was very concerning. We're in the middle of a trade war. So we essentially had a long stock bond position for almost this entire year. And so for a lot of my members, we were making out like bandits all year, and we have continued to do so on the SPY, but the TLT has just been eating at us. And that was our insurance. So from my perspective, I saw a potential 5 to 10% easy gain on the TLT with limited downside risk, which, as you'll see in our returns, is what we achieved. So had the trade war escalated, we would have had some huge gains. And for me, a huge gain's like 2%. I'm not trying to beat anyone or outperform anything. But you can see we've done well in January and February, despite the market rallying higher. March and April, we did very well. Now, again, stocks and bonds were traveling together, so it made it relatively easy trading. In May, stocks tanked. Well, guess what? That put option kicked in on the SPY. TLT shot up. we were able to still get a large gain. In June, I thought the sell-off was a little bit overdone, so we did relieve some of the protection and had a nice return, 3.2. Now, since July, there's been a whole lot of rhetoric about us going into a trade war with China. In July, they promised us a trade deal, SACA, which I was thinking may not have occurred. Only losing month. August, all of a sudden, he says, well, guess what? They're not buying anything, so we are going to go ahead with tariffs. September, October, it's just been flip-flop. One day we have a trade war. One day they're our best friends. Next day, Pence is, just bashing them about their re-education camps. We got Pompeo sanctioning companies left and right. So there's just been this crazy rhetoric. So we played it very safe with the long stock bond position. And so that's the reason why we've had relatively lower returns in the last few months. I'll jump over here. Now I'm going to update this. I think we might be closer to break even in December. But now that the trade war is off the table, I do expect we can actually outperform the markets and do very well until we get towards November. So we'll see how that plays off. We've been doing very well on the SPY trade, and I think we're going to start doing well in the TLT now that this big catalyst that's been a major concern is past us. Hopefully, now we'll see if the Chinese really purchase agricultural products. But let me give you a look at a tour of the track record. So you can see we have the total return with all strategies combined right here. And I want to point out risk versus reward. So total return is $14.53. And our maximum loss in a month is $1. Now, to put that into perspective, to earn $1 while only risking, or rather to earn $14 and to only risk $1. If we go back to the S&P 500, let's say you had bought the SPY here at 290. You're up 10%, okay? So you gained $10 if you were ballsy enough to hold this entire crash. But how much volatility did you have to hold on to? So you gave up $50 to the downside on the SPY to achieve $30 of upside. So you're actually risking far more than you've gained by being a buy and hold investor. In our strategy, as boring as it may be and as much work as it might entail, we have given up $1 to generate $14.50.
All
So
15
that's
days a
really
month.
what you want to focus on is risk against reward. So, a lot of people say, oh, well, my portfolio is up big. Well, is it really? If you go back to October, you're up 10%, and you had to hold on to almost a 20% loss. In fact, I think it was a 20% loss. So you're risking $2 to make $1 in the last 18 months, in the last 15 months in stocks. Okay, but if you follow our program, we've lost $1 to gain 14. So it's a much different risk profile. Does that make sense?
Yeah, absolutely. It's excellent.
Now, after that, I do break it down per asset class. When we first got started, a lot of people just wanted to play the SPY trades, which is fine. And you'll see I've actually achieved almost the same return in each of these portfolios. Let's see, bonds were leading. Every time one gets ahead of the other, it's not too much longer before they catch right up. So you can see we had a small crypto position, which has transformed into a larger metals position. So that portfolio has greatly outperformed the others. But that started off at a 2.5% position and it's worked its way up to 10. You got to remember, in December of last year, and for all of last year, the Fed promised us something more like a Paul Volcker environment, where he's going to be very calculated in terms of increasing interest rates, pulling down the balance sheet, and preparing us for the next recession. And that lasted all of half of 2018 until they crashed the stock market. And they've gone completely flip-flop. So that's why we've grown that position. The actual return is far higher. It's just after I diluted it significantly to get us up to this 10% position that we've seen this only show a 35% return, which I prefer because I don't want investors who are trying to get large returns in this program. It's absolutely not what I'm trying to do. But note, the return per asset is very similar over the course of time, but your volatility is greatly increased. So in the SPY, we've had several losing months, 3 losing months in 2019. Total return 12.8. Go to equities portfolio 2. This is a 10% allocation. It's far riskier. It's had far more volatility, but it's had 1, 2, 3, 4, 5 losing months in the past 13. Go to the precious metals portfolio, and it's had even more losing months, 1, 2, 3, 4, 5, 6. But when it hits the big gains, which we've talked about, our whole strategy with metals is to slow bleed, and then catch those big jumps, which we've managed to do very well. Okay, bond portfolio was on fire. And what's funny is the only month we lost money in the bond portfolio was the exact month that Powell did his infamous Powell pivot. They'll make fun of him for the rest of his career for his actions in February, where he did the remarkable Powell pivot. This is after in December, before the big sell-off, the just extreme drop into Christmas, when he said, the market's overreacting, economy's great, we're going to keep on hiking rates. It's in February where he actually went dovish and said, all right, we're not going to do this anymore. That was our only losing month in the bond portfolio until recently. And so it was only in October when the supposed phase 1 deal was signed, and then China was not coming back to their, was not making the promises they had made. And so we continued to remain long bonds until this was clear that they would. And so this provided the protection to play a pretty aggressive equities position. And the risk to reward ratio for all of these 3 months, in my mind, was around a 1.5% loss to the downside, but potentially a 10% jump if the trade war had escalated. Now it does look as though this will be delayed until 2021. So I think right around November, so long as Trump is reelected, that we're going to see sell the big rally in stocks. Yields should have climbed considerably higher. And now the worries that Trump's going to push aggressively on China again could reemerge. Now, does that mean we're not going to have any risk for all of 2020? Probably not. So I'm certainly, if you've been following me, I'm very, I wouldn't call myself bearish, but if there's a risk that's ahead of us, you know I'm going to play it super safe. And so that's really been the only time we've lost money, was playing it safe when there's a dead obvious risk ahead of us. So I'll be paying close attention to the developments with China. I think we're going to probably start putting a little pressure on Europe for tariffs. But other than that, it does seem like Trump is going to let this market really rally into the election. So we'll be keeping a close eye on that. I think the big risk is really that 10-year treasury getting too attractive. So there's your summary. Below that's the starting and ending balances for each portfolio. Now, if you want to see the exact trades, there's a tab for each of our assets. I did pull crypto out of our portfolio back on 11/14, 11/7, just because there wasn't many of our members actually following it, but I still do recommend a total 2% position in those 2 assets. And I do intend to actually get this back full throttle for our boot camp fellows, as it is a very lucrative asset to play when there's a big period of quantitative easing coming in. And so my expectation is we're going to have kind of QE light for all of 2020, and then go into super heavy QE with rates going to zero in 2021. So we probably see some decent, at least flat to slightly up moves in crypto and gold in 2020 is what I'm thinking. But I think the really big move up in those two assets will be when the Fed actually cuts those rates to zero and does real QE, which means purchasing the medium and long end of the treasury rather than the short. And then we have our boot camp trades, which we just put some positions on. As far as how each tab works, we have our stock trades in this purple area, buy and sell. We have our palette right here, currently, and for the foreseeable future. We'll rotate into this basket after a major reset. Now that doesn't mean just stocks crash. We need stocks and bonds to reset before I'd rotate us into this blue group, which will be a great period of time for us. We won't have to sit here and worry about a mega stock crash, because assets will be 50 to 70% cheaper by then. So we'll be able to do a much more passive bullish strategy after a great reset. So you can see we are looking way into the future. Emerging markets tab. Again, for the next 2 years, we like emerging markets. It's a highly liquid ETF with great options market. After a great reset, we might rotate into the top tier of emerging markets, which are these tickers right here. Same thing with the bond market. When we're at the top of a bubble and we're at the last inning, because the Fed can only cut rates to zero before we have a crisis in the credit markets. For that period, we want to be long TLT, as it's the easiest to predict, and it's the most highly leveraged. So the TLT is essentially like having 30 times leverage on the front end of the treasury because of the 30 years of interest payments. But after a great reset, we might rotate into this basket. So that is the tabs. Now let me go back to the SPY. If you scroll over, we have a section for open option writing. Now we've really simplified this. If you're a pro hedge fund trader, you might have a lot more open positions. But for our members, we're really just maintaining a single position at this point. So I'm just entering the positions straight into the closed section, which is right below. So this is where we track all our option writing. If you do scroll over a little further, this is where you have your open option purchases. Now, again, this is really designed for a little more complex of a portfolio. So I'm just placing my option purchases straight into the close section and then closing them out after the trade's done. So yeah, you have every little trade organized nicely, separated by asset class, summarized at the summary. Beyond that, if you want to go make sure the trades are real, these are not behind. Now the boot camp content is behind a password protected firewall. However, the advisory trade alerts, because they're so frequent and they're closed out, we're publishing these after they're closed for the whole world to see. You have your Monday, Wednesday, Friday trades in this tab, your Tuesday trades here, and your Thursday trades here. So you can go back and look at all 13 months of trade alerts and really audit the whole enchilada. Does that all make sense, Gary? Okay, great. Let's take a look at some of the news.
Yes, got it. Thank you.
Sure. Yeah, I hope you enjoy it. And okay, great. So I'm going to talk about news. So some of the biggest news isn't something we'll see in the Twitter feed, but to see Jeffrey Gundlach, Stanley Druckenmiller all turn bearish on the bond market was really the final decision for me to also pull that trigger this week. Also to see that China is actually confirming that they're going to sign this damn trade deal. So I'll be keeping a close eye. We can just calculate. They need to make around $4 billion a month of ag purchases. Otherwise, that could be a potential warning sign that they're not going to live up to it. And then you're back to trying to predict Trump. Very hard to do. So if I were to go back long bonds into 2020, it would either be because the yield crept up way too high, around 2.7, 2.8 on that 10-year, or it looks like the trade deal is breaking down. Okay, so that's one. Two, we saw, I can't remember if it was Sweden or Switzerland. One of those banks actually made a historic move to go from a negative policy rate to flat. And if we see the Euro ECB make a similar move, there could be a whole wave of negative yielding bonds starting to push into positive territory, which is going to really create a shock wave in the bond market. So without some sort of global fear, it's going to be very difficult to be long bonds until they really have sold off significantly. So that's kind of the big news that's flowing right now. I think everybody's starting to figure this out and trying to understand what are they going to do with this massive position that's now losing money quickly. So that's one. Two, the Democratic debates were very interesting last night. Notably for me was really two things. One was Pete Buttigieg was extremely hawkish on China and critiquing Trump. In fact, almost all of the Democrats were, even Joe Biden. So that has to be alarming for the Chinese to see that their actions are making shockwaves worldwide in a negative tone about their culture, about the practices of their education camps, about their surveillance of their people, about them cheating and stealing. So I know they're not happy about that, but I think they're learning that perhaps it's a smarter strategy to try to avoid all the heat and simply buy some agricultural purchases. So I think at this point, they may concede Trump will win the election and buy these agricultural products and try to just get through the next 5 years and essentially let the U.S. just bankrupt itself. The U.S. is on track to bankrupt itself just from our fiscal policies. So that might be their thinking and why they've decided to finally, to some degree, give into this trade deal. So we'll see if that's really the truth. Joe Biden had a better performance than I've seen in his past speeches.
Who's at the door?
And then the billionaire had a pretty good pitch. The Democrats are now selling going green as an opportunity to create massive jobs, which I think might sell well. And perhaps a good idea, perhaps not. Yeah, let me go ahead and mute the crowd 1 second. So that, for me, that was the most interesting highlights of the Democratic debates last night. Joe Biden's still in the lead. They asked him if he would run for two elections because he can be 82 once he gets out. And he said, maybe. We got to see how I'm feeling. The poor guy's had a hard time really even making sentences in the last few Democratic debates. He definitely performed better. Now, Jeffrey Gundlach critiqued Pete Buttigieg's performance last night. I thought it was excellent. And not that I'm voting for Pete Buttigieg, but those are the highlights from that. As far as some highlights from the news feed, Wilbur Ross says we could add tariffs if China doesn't uphold the trade deal, so we know where we'll go right back to if they're not purchasing agricultural products. So will China try to give Trump a hard time? That's tough because from their standpoint, they got to be thinking, all right, the Democrats, the whole world's now talking trash about China. They keep pulling off sports from the air. If anyone critiques them, I think this is just creating this reverb that's not in their best interests. So I'm now in the camp that I do think China will try to keep Trump off his back and push this into let's see, so it would be 2024. So if we get some very progressive Democrats into the White House in 2024, because Trump's policies are going to be great for stocks. They're going to most likely create an even bigger wealth divide, probably push real estate prices higher with low interest rates. So this whole movement of people who want to strip wealth away from the wealthy and redistribute it, create massive fiscal spending, all those sorts of things are really in the books for America, whether it's this election or the next. So I think China can allow the US to just defeat itself with poor fiscal policy and expansion of debt, versus hoping that they can get Trump out of office and someone who's more pro-China, because it just doesn't seem like there's anyone pro-China whatsoever. So that's my read on the China trade war at this point, which is changing quickly. I was worried that they would give him a hard time, and they still might. So we'll keep a close eye on that. We got USMCA coming through, which will be very bullish for US stocks. Plus, we may have a mid-class payroll tax cut coming, which will boost spending. So there's a lot of huge positives hitting the US markets for 2020. That with low interest rates at 1.75, plus we're adding $60 billion a month into the balance sheet. So this all adds up to, you got to be crazy not to be long risk until something bad happens. In the impeachment, Nancy's not pushing the impeachment to the Senate, so the drama continues to drag on. Mitch McConnell had a beautiful speech yesterday morning, about 30 minutes. Bottom line of his speech was that because of the process that was held in the House to create this impeachment, that he doesn't even want to give it the time of day to set a precedent in terms of what's a viable impeachment and what's not. And so Nancy Pelosi is not even going to push it to the Senate until she thinks she likes the way. So we'll see how long that will draw out, keeping a close eye on that. But as far as markets are behaving, they don't seem to care. Looks like President Xi is not going to be in Davos, where they're hoping the two would sign it. Instead, he's going to send Premier Liu to Washington, D.C. They're hoping this will get signed in January. If that really is signed, I think that'll give us a huge dump in the bonds and a big rally in stocks from here. So keeping a close eye on that. We have the quad witch, so a whole bunch of 4 different expiration dates are expiring at the same time today, which can be bullish and create a lot of volatility. So that'll be great for our position if that is the case. Fed balance sheet is at all-time highs or it's on track to be at all-time highs with the $500 billion in repo that they're adding in the next 30 days. Now, once again, if you've been just jumping into that news, the repo is a great deal for banks because it allows them to hold their treasuries until a crisis happens. So they can collect interest, they can get a loan from repo to turn around and reloan out for additional income. And then if they can hold their bonds long enough, everyone expects rates eventually hit 0. And that's when they would sell them during real QE instead of fake QE. And that's really the big news. Those are the key points to be focused on. And the bottom line is we could see a massive melt up in stocks, which we're positioned for perfectly. So we're playing the downside on the TLT and the upside. Let's see how the TLT is looking today. And TLT selling off. So everything's going on all cylinders here. Gold, again, I would suspect not to see a lot of action, and then big spikes in price based on fears of inflation and poor monetary policy. And so that's really a wrap. Let me go ahead and put this back on you, Dean, and see if anybody has any questions. All right, guys, do we have any questions out there? You still there, Dean?
Yeah.
Okay, great. I'm gonna go ahead and make you the host.
All right, guys. So first off and foremost, thank you for your time. Appreciate you all coming in. Like I said earlier, we do have 2 spots left on the 50% discount today to get the service and the boot camp. So definitely look forward to welcoming you into that and showing you how to give your capital the protection it deserves. Give me a call, 505-322-7515. And just want to kind of quickly touch back on this. The whole system, the whole methodology is built around Warren Buffett's top 2 rules. Number 1, never lose money. Number 2, don't forget rule number 1. So definitely look forward to helping you understand that process and how we get there. Give me a call at 505-322-7515 to go ahead and lock in that 50% discount for both the advisory service and the boot camp. And that's it for me. Anything else? Any questions, guys? Any last comments, questions, concerns? Anything we can help with? All right, guys. Well, definitely look forward to talking with you on the phone in our next interaction. Once again, 505-322-7515. Write down that number, save it in your cell phone, or write it on a piece of paper and tape it to your computer, and give me a call. Thanks, folks. Have a wonderful day.
Thanks, Dean.